Welcome to another episode of Taking Stock for the week ending the 12th of December 2025. I'm Kien, Head of Research at Stock Doctor, and joining me today is our Senior Portfolio Manager, Matthew Swartz, to stream to your thing share market. Welcome aboard, Matt. I can't believe it's less than 2 weeks before Christmas.
I know it's so fast approaching, isn't it, Kien? It's a pleasure to be joining you again.
Yeah, great to have you on board, and I hope you get your Christmas prezzies sorted. But as always, a reminder, the information we share today is of a generic nature and doesn't consider your personal situation. Remember, shares are volatile, and any past performance isn't a reliable indicator of future performance. Well, Matt, earlier this week, both US and Australian markets have struggled to gain momentum before rallying on the back of stronger commodity prices. Investors appear largely focused on changing interest rate expectations. In the US, the Fed, they delivered another 25 basis point cut, taking rates to roughly about 3.5 to 3.75%. And they were very clear that further hikes aren't on the table for now. And that helped keep Wall Street near record levels, even though inflation's still above target and the jobs market is only slowly cooling.
Yeah, it's somewhat of a different picture in Australia, isn't it, Kien? The RBA left the cash rate at 3.6%, and Governor Michelle Bullock pretty much ruled out the possibility of rate cuts in 2026. In fact, markets are now pricing in the possibility of one or even two rate hikes next year. And that's due to concerns around inflation running hotter than expected. And this can clearly be seen with traders now pricing in interest rates to rise from 3.6 to 3.9% in late 2026, when only a few months ago, the market was expecting further policy easing in 2026. So a stark difference now.
Yeah, quite a big change then, Matt. And that hawkish tone has pushed local bond yields higher and kept a lid on the ASX, particularly in interest rate sensitive sectors like technology, REITs, and consumer names. And lower interest rates, they tend to be better for equity markets. But at the end of the day, the changing market dynamics just contributes to the noise, hence the importance of focusing on the fundamentals. But let's now turn our attention to some star growth stocks. Technology One, a corporate management software provider with dominant market positions across councils and universities, the share price has pulled back after its financial year 25 result just recently. What's been driving this?
Well, I think, as you pointed out, part of the pullback has just been related to this rotation out of high multiple growth stocks as interest rate expectations have turned more hawkish. But Tech One, specifically, the market initially sold down the stock because its annual recurring revenue and profit margins were marginally softer than expected.
Yeah, interesting. There's now also a governance overhang with the stock tied to the situation at corporate travel management. As most investors will recall, corporate travel is currently suspended from trading after a major accounting scandal in its UK division, where a forensic review uncovered over £80 million of overstated revenue and years of improper revenue recognition.
And the reason why we're bringing that up is because two former corporate travel finance executives now do work at Technology One. It's the CFO, Carl Bennett, and the internal audit lead, Carla Beaton. There are no allegations specifically against either individual, and Technology One has reaffirmed its confidence in their management.
Yeah, but given the scale of the corporate travel scandal, investors are naturally cautious at the moment. Until corporate travel's investigation concludes, the share price may continue to trade at a discount to fair value. But for long-term investors and those who are patient, this could represent opportunity. And on the topic of management as well, let's now turn our attention to PWR Holdings, a borderline star growth stock known for its advanced cooling systems used in high performance motorsport, including around 90% of Formula One teams. Now, the big news this week is a major leadership transition. CFO Sharon Williams has been appointed CEO and managing director, replacing founder Kees Wheels, who stepped back to be the chair. Now, Sharon has a strong strategic background across automotive and electrical manufacturing, but will this impact its turnaround story?
I wouldn't have thought so. Strategically, the investment case hasn't really changed. The founder remains as chair, while acting CEO Matthew Bryson returns to his role as CTO, ensuring continuity. PWR's vertically integrated model, global footprint, and growing exposure to aerospace and defence remain its key strengths. Despite near-term tariff and compliance cost headwinds, the business is expected to recover strongly this year with ROE above 14%, meaning that it could come back into our star growth stock portfolio next year.
And this week, we're putting Bapcor, the code is BAP, under the microscope. Now, the group behind Burson's, Autobarn, and Midas. Now, this was once a highly profitable star growth stock, but was removed from our portfolio in early 2019 as return on equity began to decline. The share price is now down about 60% over the year. Investors are asking what has caused such a dramatic reset.
Well, the latest weakness is centered squarely on the trade division, which has historically been Bapcor's profit engine. Trading in October and November undershot expectations. Tools and equipment revenue declined, and heavy discounting to defend market share has eroded margins, with net profit margins sitting at a paltry 2%. The company also revealed the previous accounting errors in trade will cost them $15 million, with another $4 million in restructuring charges.
Yeah, quite a few issues there, Matt, and that's directly fed into another earnings downgrade. It's second in 3 months. Full year underlying profit is now guided to around 44 to 49 million. And that's about 18% below market expectations. And the damage isn't isolated. Earnings revisions have fallen roughly 35% over the past quarter, while return on equity is currently at 5%, a multi-year low.
And what's more, with the first half profit being extremely soft, there is a reliance on a sharp second half rebound, which is making investors very uneasy, especially after 3 consecutive downgrades.
Yeah, that's causing a bit of an overhang, and we don't expect that to kind of be removed anytime soon. But the boardroom turbulence hasn't helped either. You had Bapcor. They've cycled through directors, senior executives, and even appointed a turnaround specialist as chair after pressure from major shareholders. Although the business appears financially healthy for now, you've got lender covenant waivers. They are being negotiated for financial year 26. And with earnings revisions moving down quite rapidly, there are now early signs of financial weakness.
And look, the dividend yield does look pretty attractive, but it's all superficial because the share price has obviously collapsed, and the dividend trend itself is declining, meaning payouts remain uncertain. And with short interest above 5%, the market is clearly skeptical here.
So while Bapcor screens optically cheap, it does remain a high uncertainty recovery story, and investors should be cautious until execution improves and its core trade business stabilizes. For question of the week this week, a member has asked, how useful is the PE ratio when valuing a stock? Now, the PE, or price to earnings ratio, is one of the most widely used valuation tools because it's simple. It just shows how much investors are paying for each dollar of a company's forward annual earnings.
But like all financial metrics can, the key here is context. A PE on its own can oftentimes be somewhat misleading. A stock looks cheap sometimes because it has high risks, poor financial health, or the market is expecting earnings to fall. That's what we call a value trap. And other times, a high PE may be justified if a company is high quality and has strong growth prospects ahead of it, just like Pro Medicus. So it's often more useful to compare the PE with its own historical average or its historical premium against the industry group that it operates in.
And Stock Doctor does make this easy under Golden Rule 5 as well. But investors need to be extra cautious, especially with cyclical industries like resources. Miners, they often look cheapest at the top of the cycle when commodity prices are high and profits are inflated, and most expensive at the bottom of the cycle when earnings are depressed. So a low PE in mining is not automatically a bargain.
Exactly right, Ken. That's why valuation is a secondary golden rule. PEs and valuation are oftentimes quite subjective. So instead, it could be helpful with combining the PEs with primary golden rules such as the financial health, return on equity, profit margins, earnings revisions, and piecing that together with outlook and active risks to provide real perspective.
Yeah, definitely, Matt. But in short, the PE, it could be a helpful starting point, but understanding why a stock trades at that multiple is what really matters for long-term investors. But that's all we have time for today. Thanks, Matt, again. It was very insightful.
Thank you, Ken. It's my pleasure.
And also, we spoke about motorsports with PWR Holdings earlier, but if you want to invest in motorsports, you can do so under Prime's alternative investments. They also offer other services, including self-managed super funds, accounting, financial advisory, and of course, property. For more information, please refer to Prime section on our Stock Doctor page. Lastly, as well, if you have any family or friends who might benefit from Stock Doctor, please feel free to share us with them. We continue to grow through our members, and we generally appreciate your ongoing support. Until next time, have a happy, healthy, and prosperous week ahead.